Hello everyone, I'm Sebastian Y, and this is Principles of Macro. In this video, we're going to talk about exchange rates and purchasing power parity. Now that we're starting to talk about international trade, we need to think about exchange rates between the currencies of the countries doing the trade. The nominal exchange rate is the rate at which one currency can be traded for another. As an example, let's think about the exchange rate of US dollars, known by the code USD, for Canadian dollars, known by the code CAD. The exchange rate in September of 2024 was 1 US dollar for 1.3546 Canadian dollars. We can also express this the other direction and ask how many US dollars per Canadian dollar. To do that, we would just take the reciprocal. And so we can exchange 1 Canadian dollar for 1 over 1.3546 US dollars, which is about 73 cents. For consistency, I'm going to generally refer to exchange rates using the first format, 1 US dollars for an amount of foreign currency. You might hear a few different terms that describe how exchange rates change. When the US dollar increases in value relative to foreign currencies, then we say it appreciates or strengthens. If that were to happen in this example, we would be exchanging 1 USD for more than 1.35 Canadian dollars. And on the other hand, if the US dollar declines in value relative to foreign currencies, we say that it depreciates or weakens. In that case, we would be able to exchange 1 US dollar for less than 1.35 Canadian dollars. I've put on the screen the exchange rates of the 1 US dollar for Canadian dollars, euros, and British pounds. Whenever the lines go up, that means that the amount of foreign currency that exchanges for 1 US dollar is going up. That is to say that the dollar is strengthening. Whenever the lines go down, that means that the amount of foreign currency per US dollar is lower, meaning that the US dollar is weakening. The currencies of most large countries in the world right now are called floating currencies. That is to say that the exchange rates are free to fluctuate according to market conditions. As you can see, all three of the Canadian dollar, euro, and British pound fluctuate in value frequently relative to the US dollar, and that's because all four currencies are floating. Other currencies are pegged to the value of something else, whether that's another currency, the price of a basket of goods, or gold. Since most countries have abandoned the gold standard, pegged currencies are a lot less common than they used to be, although the most recent example of a pegged currency was the Chinese renminbi. In Chinese, that means the people's currency. The RMB was pegged to the US dollar until 2005. I put on the screen another graph showing the exchange rates of US dollars to RMB, or CNY, on the graph, and the Mexican peso, MXN, on the graph. You can see that the Chinese exchange rate is a flat line from the late 90s through 2005, during which time the RMB was fixed at an exchange rate of 8.27 per US dollar. Since then, you can see the exchange rate change a bit, but not to the extent of a free-floating currency like the peso. That's because the Chinese government still manages the exchange rate to some extent. The peso, on the other hand, was pegged to the US dollar until 1995, which is where our data on this graph starts, and you can see that its exchange rate fluctuates quite a bit over time. Next, we're going to talk about real exchange rates. The real exchange rate is the rate at which a person could trade the goods and services of one country for the goods and services of another country. So you can see here that real exchange rates are independent from units of currency. Just like the real variables we talked about in the closed economy, which are measured in physical units, and nominal variables that are measured in dollars. Same idea here. To calculate the real exchange rate for a good, we will take the nominal exchange rate times the domestic price for the good, and divide that by the foreign price for the good. Let's think about a real-life example of this. Let's suppose you wanted to purchase a farm-to-table whole beef. When you purchase a whole beef, what that means is that you get all of the meat butchered from an entire cow. It's also possible to get a half beef or quarter beef or a tenth beef as well, but let's think about the entire cow. Now, when we think about the amount of meat that you get from a whole cow, that's over 500 pounds. So let's think about this on a price per pound basis. I used the internet and found a company called Lancashire Lamb Boxes in the UK, and they sell a whole beef at a price of £4.35 in British pounds per pound of meat. I found another company in the US called Oxbow Cattle Company, which sells their whole beef at a price of $4.90 in US dollars per pound of meat. We can also look up the nominal exchange rate in September 2024, which was 0.7564869 pounds per dollar. We can use all three of these pieces of information and plug them in to our equation to figure out our real exchange rate. First, we plug in our nominal exchange rate of 0.7564869 pounds per dollar times our domestic price, $4.90 per pound of American beef, and then divide that whole thing by the foreign price, 4.35 British pounds per pound of British beef. Now let's do the math. On the top of the fraction, we can multiply this out. 0.7564869 times $4.90 ends up at approximately 371 British pounds per pound of American beef. Divided by the British price of 4.35 British pounds per pound of British beef. Notice that what we've done here is we have canceled out the American dollars so that both the American and British beef are in terms of British pounds. But now the pounds are going to cancel out, and we can do the math and get approximately 0.85 pounds of British beef per pound of American beef. So what this tells us is that American beef is cheaper than British beef, because for every pound of American beef, you can only get 0.85 pounds of British beef. This implies that ceteris paribus, if a person had the choice to buy British beef or American beef, they would go with American beef because it is cheaper. This is an important idea to remember, and we will revisit this later on. Of course, beef is not the only thing that people consume, and we might be interested in thinking about the overall real exchange rates from one country to another, and we can do that using a basket of goods. We've actually already done this all the way back when we calculated CPI. We're going to generalize this to think of P as the price of a basket of goods in the United States, and P star as the price of that same basket in the UK. And this basket could include all kinds of things, not just 500 pounds of beef. But remember that the price of the basket in the US will be in US dollars, and the price of the basket in the UK will be in British pounds. And so to use this to get our real exchange rate between the two countries, we will take our nominal exchange rate, which we will call E, times P divided by P star. If the real exchange rate ends up being less than 1, that means, on average, American goods are cheaper than British goods. But if it ends up being greater than 1, that means that, on average, British goods are cheaper than American goods. Consumers in both countries will have an incentive to the extent that they can, buy goods that come from whichever country is cheaper. The nominal exchange rate of E will also have a direct impact on this. As E increases, the US dollar becomes stronger relative to the British pound, which makes American goods more expensive relative to British goods and may end up sending consumers over to the UK to buy things instead of the US. If E were to go down, the opposite would happen. We're going to finish today by talking about the theory of purchasing power parity. Purchasing power parity is a simple way to think about how exchange rates come to be. Purchasing power parity is based on the law of one price, which says that the price of a good should be the same everywhere in the long run. The way that we get to the law of one price rests on the idea of arbitrage. To illustrate the idea of arbitrage, consider the market for a good in two different places. Let's say North Carolina and South Carolina. We have a price and a quantity in each state, and we've got a demand curve in each state, as well as a supply curve. We'll label those up. Now let's suppose for the sake of this example, we're going to look at the markets for rum in North Carolina and South Carolina, and what you can see is that the price of rum in North Carolina is higher than that in South Carolina. So what could potentially happen here? An enterprising rum runner from North Carolina could go south across the border, start buying up a bunch of rum there, bring it up to North Carolina, and sell it for a profit. The difference in the price between the two states would be the arbitrageur's profit. But what's going to happen in the long run? In the long run, all of these people going to South Carolina to buy rum is increasing the demand over there. And over in North Carolina, all these people showing up with South Carolina rum are going to increase the supply. This is going to increase the price over here and decrease the price over here. And that's going to continue until the price across the two states has equaled out. Now there's no more incentive to cross the border and bring goods back over because there's no profit to be made. This concept can be extended to international trade as well. The implication of this is that the real exchange rate should always be 1. The prices of any good should adjust so that, accounting for the nominal exchange rate, the prices will be the same in both countries. Going back to our whole beef example, if the real exchange rate must be 1, it must be the case that the nominal exchange rate times the domestic price of $4.90 divided by the British price of 4.35 must equal out to 1. Let's solve for E by multiplying both sides by the British price. And then dividing both sides by the American price to get E equals 435 British pounds divided by 490 US dollars. Doing that math, we get 0.89 pounds per $1. Of course, we know from what we were talking about earlier that that is not the actual nominal exchange rate. The nominal exchange rate in real life is about 0.75, not 0.89. We will return to this fact in a minute. For now, we can generalize the concept of purchasing power parity to say that 1 not only equals E times the ratio of beef prices, but also E times P over P star. Remember that those are the prices of an entire basket in the United States and the UK. Multiplying both sides by P star and dividing both sides by P, we can solve for our exchange rate, which will be P star over P. As you can see, if our basket was 500 pounds of meat, we have an equation that looks very much like this. We've learned in the past that the overall price level in a country is directly impacted by the money supply. So let's suppose that the Fed were to expand the money supply. That is going to raise prices in the United States. That's going to bring our P in the denominator up, and that's going to drop the exchange rate. This will mean that it takes fewer British pounds to exchange for 1 US dollar. Now we want to come back to the idea that purchasing power parity does not always reflect reality. As you can see from our example, the exchange rate that purchasing power parity predicted, 0.89, is not the same as the exchange rate in real life. One reason for this is that international arbitrage is not always easy or even possible at all. Think about our example of transporting 500 pounds of beef from the US all the way over to the United Kingdom. Not an easy task. Think about other goods and services like haircuts or housing that really can't be transported over international borders at all. Furthermore, a consumer might simply prefer the goods from one country versus another. Maybe one person likes the taste of British beef and another person likes the taste of American beef. It could be that American beef and British beef taste different because of the different breeds of cattle that are raised in those different places. Connoisseurs of wine and spirits often use the term terroir to describe the unique characteristics of wines and spirits produced in different parts of the world. For example, rum made in Jamaica tends to have a funky ripe banana aroma, whereas you get a toasted brown sugar one from Guyanese rum. So we've seen that purchasing power parity is not a perfect theory of exchange rates, but it is a good starting point, and it communicates the idea that relative price levels are an important factor for determining nominal exchange rates. Coming up, we will apply these concepts to a more comprehensive theory, but for now, that's where we'll end it. If you have any questions, please let me know. Thanks for watching.